The US Fed could be facing monetary policy hell, but despite this, Jerome Powell claimed victory last week, saying that the US economy is in very, very good shape.
U.S. economy is just performing very, very well.
And Powell didn't stop there. He took a victory lap.
The outlook is pretty bright for our economy. Our policy's in a really good place. I expect another good year next year.
But based on the reaction of the market last week, investors heard something very different. Hey, my name is Kyle, and I look at data and facts in crypto. And since the economy and market monetary policy drives markets, let's look into what Jerome Powell said last week in detail. Powell delivered news of a rate cut and an ease of quantitative tightening, which should have been good news for markets.
The market committee decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by a quarter percentage point. We also decided to continue to reduce our securities holdings.
What investors heard weaved into Jerome Powell's optimism was a lot of uncertainty. And that started with inflation prints. Over the last 4 months, they've been increasing.
The median projection in the SEP for total PCE inflation is 2.4% this year and 2.5% next year, somewhat higher than projected in September.
But inflation was minor compared to the amount of uncertainty and attention that labor markets and unemployment received.
But you're right, though, and I read out some of the reasons. We do think the labor market is still cooling by many measures, and we're watching that closely. What's going on in the labor market is that the hiring rate is low. So if you have a job, you're doing very well, and layoffs are very low.
And to Powell's credit, he did point out that the unemployment rate is at 4.2-ish%, which is the same as it was back in June of this year. But what he's ignoring is the momentum in the unemployment rate, and that is what one of the most reliable recession indicators measures. That is the SAM recession rule that measures the 3-month average of unemployment. But momentum in unemployment is exactly what investors became worried about, but not in itself. It is in combination with the stickiness of inflation, and it's because it changes the way the Fed looks at future rate cuts. That is the summary of economic projections, or the SEP, something we talked about last week before the Fed meeting. Remember, we're looking for 4 rate cuts. I think 3 would not be too bearish. 2 or 1, I think, would make markets absolutely go wild, and not in a good way. And unfortunately, that's what happened. The Fed decided to go from 4 rate cuts projected for 2025 to only 2. So it's a balancing act for the Fed. Cut rates too quickly and lose track of inflation, which would be devastating for monetary policy, or keep rates elevated for too long and hurt growth in the economy, aka increase unemployment. And the ultimate problem with this is that Fed actions and monetary policy acts on a delay, something that Powell admitted last week.
And it's not made any easier by the fact that that our policy works with long and variable lags.
So effectively, what market participants were voting on last week with their dollars was that the unemployment freight train will eventually bring the economy down. Now, you might be asking, do I think markets are going to crash into oblivion from here? And honestly, no, I think this is just a correction. I don't see the topping patterns that, I expect to see. Now, not financial advice for you, obviously, but there are some additional patterns that I expect to play out. And if you've been watching my videos, you might know what they look like. So I hope this video was useful, helped you understand what the Fed is thinking and why markets reacted like they did. If this was valuable for you, throw me a sub. Would love to get you back on some more episodes of The Morning Coin. Thank you for watching, and we'll see you next time.